So as interest rates moved up rapidly in 2022, investors started looking for yield and started investing in GICs, or guaranteed investment certificates, as well as high interest savings accounts. But as rates started to come down in 2024, the relative attractiveness of those short-term money market instruments compared to high-quality dividend-paying companies has started to erode. So currently, there is over $200 billion in excess savings in GICs and high-interest savings accounts. As these investments come due, Canadian dividend-paying companies offer an attractive alternative to picking up yield in the market.
Among equities, paying a dividend signals quality. Dividend payers tend to have proven business models, strong free cash flow generation, they're more disciplined from a capital perspective, and their earnings are less variable over time. Relative to fixed income, Canadian dividend stocks offer share price appreciation potential as well as dividend growth potential. Canadian dividends are also advantaged from a tax perspective. So I want the portfolio to offer competitive yield and participate in the upside of a market while protecting capital to the downside. The fund is a combination of higher dividend paying stocks in more mature industries, as well as lower yielding stocks with growth potential. Currently, we see attractive valuations in the traditional dividend paying sectors, such as utilities, financials, real estate, and telecommunications. But dividend sustainability is absolutely key. In the simplest terms, this means we want to avoid dividend cutters. This sounds very simple, but it requires a lot of fundamental analysis. We do very detailed discounted cash flow analysis, as well as downside scenario valuation analysis to make sure that companies are able to pay those dividends over the longer term.
So I think investors should be adding dividend-paying funds to their portfolio for 4 reasons. Number 1, diversification. Dividend-paying companies tend to have low correlations to other parts of the market, such as high-growth technology companies. Secondly, downside protection. When markets correct, high-quality dividend companies with good, strong cash flows tend to outperform the market in those periods. Thirdly, lower volatility. And this gives investors a smoother return stream over time. Fourthly, they also enjoy the benefits of some tax advantages. An investor that earns $100,000 a year would pay a marginal tax rate of over 31% on interest income. If they received that income from a Canadian company and that was eligible for the dividend tax credit, they would be paying a marginal tax rate of only 9%. In other words, $1 earned in eligible dividend income is worth more than $1 earned of interest income.